Right, everyone, I'm going to show you a powerful risk management strategy to win only 30% of your trades and still make money in the markets. Now, this is exactly the same strategy which I've taught my students, okay, how to turn £1,000 into £12,000 or 5,000 into 25,000, which I'm going to show you shortly, okay, in a very short period of time. Now, this isn't just another basic risk management strategy. This is going to take you from blowing your trading accounts to being consistently profitable with only a 30% win rate. And this video is going to walk you through this very simple step-by-step process so you never ever have to watch any other risk management video again. Step 1, volatility. No matter what asset I'm trading, whether it's currencies, crypto, commodities, or stock markets, I need to know how much does the asset I'm trading fluctuate over different time frames. So let's say I'm a day trader, okay, and I want to trade Euro USD. Where do I place my stop loss is not just a random price. I have to look at historical volatility so I know where to place my stop loss, so I give the market the room to breathe without my stop loss getting hit and taken out of my trades. So let's look at the historical volatility of Euro USD. We have the daily data of the currency pair going back for the past 10 years, okay? And what we can calculate is how much has the currency pair fluctuated over the past 1 week, 1 month, 3 months, 1 year, up to 2 years, okay? You want to focus on volatility over the past 1 year because it gives you enough data to know, okay, this is how much is fluctuating every day over 12 months. 0.71% is the daily volatility of Euro USD. All right, so all I have to do is come over to Euro USD and look at the live price, 103.560. I come into my spreadsheet and I put the live price for the currency pair. Now, remember, the daily volatility is 0.71%. So in my spreadsheet, I type in 0.71%. Now the spreadsheet tells me my stop loss needs to be 74 pips to give the market the room it needs to breathe over a daily time frame without my stop loss getting hit. So what we can do is get the measurement tool and we can go from a live price down to 0.71%, and let's see what the market tells us. The stop loss needs to be 73 pips, and that's bang on what the spreadsheet tells us. So we know where to place our stop loss. Step 2, stop loss automation, okay? Inside the spreadsheet, we come down to this second column and we type in 0.71, which is the volatility, and it spits out our stop loss price, 102.825. So if I come onto Euro USD and I go down 0.71%, which is 73 pips, that the spreadsheet told us, the stop loss price is 102.828, okay? Pretty much bang on the money, all right? So the spreadsheet tells us exactly where to place our stop loss based on the historical volatility so we don't get stopped out. Step 3, risk to reward ratios. This is how you can only win 30% of your trades and still make money, okay? So when we look at the spreadsheet, the stop loss has to be 0.71% away from the live price, which means our take profit needs to be at least 3 times bigger than our stop loss, okay? Which means if we win a trade, it's gonna take 3 trades in a row just to break even from where we started. And I'll show you as an example. So if the stop loss is saying 0.71 and that's our stop loss price, our take profit has to be 2.13%, giving us a take profit price of 105.766, okay? So let's have a look at the live price of Euro USD. We need to make sure that our take profit is 2.13%, okay? And that is exactly here, giving us a take profit price of 105.765. And if we look back on our spreadsheet, that's the exact price the spreadsheet spat out to us, 105.766, okay, 1 pip difference. Now you're probably thinking to yourself, well, why is this important? Well, I'm going to show you how this 30% win rate comes from the risk to reward ratio. Here I have some calculations. If you had a £10,000 trading account, in this spreadsheet, you could put any balance, okay, that your trading account starts with, okay? So if I'm risking, let's say 15% of my account on a trade, I would lose 1,500 of my 10,000 account balance if this trade hits my stop loss. If I have a 3-to-1 risk to reward, I'll make 3 times as much if it hits my take profit, okay? So on a 10K account, I'll make 4,500 when I win a trade. And then again, if it's 3 times as much as my potential loss, I'll lose 1,500. Now look what happens with a 3-to-1 risk to reward. This is how you could be a terrible trader and still make money, okay? If I was to win my first trade and make 4,500 on my 10,000 account balance, I'm up to 14,500. If I win a second trade, okay, I then go up to 19,000. Okay, because I've made 4,500 profit twice. If I win the third trade, my account balance now goes up to 23,500, okay, because I've won 3 trades in a row. 4,500 times 3, right? Now look what happens. If I was to then lose the next 7 trades in a row, okay, look what happens to my account, all right? So I've made 13,500 profit. Now I lose a trade and I lose 1,500 of my total profit, okay? And each time I lose, I then take away another 1,500. I could lose 7 of the next trades I take, and I still end up in a $3,000 profit on my 10,000 account balance, okay? Do you see the power of risk to reward? If you always make sure that your take profit target is 3 times as much as your stop loss, when you do hit a winning trade, now it's going to take you 3 trades in a row just to break even. So you could take 10 trades, win only 30%, and it's still going to be up by 30%. That's how the professionals trade. You don't have to be right every time. But look over here, if you start to get 50% of your trades right, so you win a trade, lose a trade, win a trade, lose a trade, then you're talking about your account being up 150%. Okay, so you could start with 10,000 and then your account would be 25,000. That's why when I show you the testimonial shortly, you're going to see members growing their account from 1,000 to 12,000, 5K to 25K, because of the power of risk to reward. But you need to know where to place your stop loss using volatility to know where to place your take profit, so you don't get stopped out your trades and you give the markets a room to breathe, so you can get to your winning take profit prices and stay in the game. Now, step 4, automated position sizes. Now, before I get into this trade, how much I put on the trade is going to be dependent on a percentage of my account I'm willing to risk, okay? So let's say I decide that I'm only willing to risk 5% of my account. What I do is I come over here and I put my account balance in this spreadsheet. 10,000 could be my balance, or let's say some of you are trading with a bigger balance, maybe say you're trading with 100,000, okay? It doesn't matter. You just put your numbers in. Now what this spreadsheet does, it automatically calculates what is 5% of 10,000, okay? And that would mean that you'd be willing to risk 5,000, but no more, okay? So you don't blow your trading account. Now, if you want to risk 5% of your account, how much you place on the trade is going to be dependent of the 5,000 you're willing to risk and then how many pips the stop loss is. Because look, it says you can trade the currency pair at $68 a pip. Why is it saying $68 a pip? Because you have to divide 5,000 by the stop loss of 74, which means if I have a trade on with $68 per pip and the market goes against me by 74 pips, I'm only going to lose 5,000, okay? And we can look at the calculation really easy here. If I have $68 a pip and I times that, okay, by 74 pips and it hits my stop loss, bingo, I'm only going to lose 5K, guaranteed, okay? Now this is very important because what it tells us automatically on the spreadsheet also is if I need to trade $68 per pip to make sure I don't go above my 5% predetermined risk and I know where to place my stop loss, okay, because it's giving me the price, now automatically I know my lot sizes. I know if I'm doing $68 a pip, well my lot size, if I'm trading a standard account, is 6.8 lots. Automatically, the spreadsheet tells you how much your lot size is based on the calculation. So just remember, when you're getting into a trade, you need to know where to place your stop loss based on volatility, but how much you place on the trade is going to be predetermined by how much you're willing to risk, okay? So let's say, for an example, I now want to risk 10% of my account. So 10,000 is 10% of 100,000. And notice my pip value is now $136 per pip because the stop loss is 74 pips. So I have to divide 100,000 by 74 and it tells me my pip value is $136 per pip. And let's have a look. $136 times the stop loss of 74 pips, bingo, that's my 10,000. Now I'm guaranteed if this trade hits my stop loss, I'm only going to lose 10,000. So how much you place on the trade, again, is not a random amount. You need to have calculated what am I willing to risk, where is the stop loss, then I get my position size. And this is the key that that so many people don't understand, and that's why you keep blowing your trading account, okay? Now, notice how our take profit, if it hits our price of 105,766, we're gonna make $30,000 on this trade, okay? Which is, again, a 3-to-1 risk to reward for how much we're willing to risk, okay? So guys, now you're seeing why so many people are losing trades to the markets. They need to understand the volatility numbers so you know where to place your stop loss, because where you place your stop loss is going to be dependent, using your 3-to-1 risk reward, where you have to place your take profit, okay? And once you know where to place your stop loss and where to place your take profit, how much you put on the trade is literally going to be calculated using how many pips the stop loss is, okay? These are not random numbers. You have to have the volatility data. Otherwise, you don't know where to place your stop loss, you don't know where to place your take profit, and you don't know how to calculate your lot size. And this is why everyone keeps blowing their trading account. Now, I'm going to show you other currency pairs like USD JPY. Now, this is exactly the same for whether you're trading commodities, crypto, or stock market indices. The daily volatility of USD JPY is 0.84%, which means if the live price is 155,156, then if we want to do 0.84%, that would mean the stop loss is going to have to be around 129 pips away on a daily basis, okay? So if you've been trading USD JPY and you're trying to have a stop loss of 10 pips, 20 pips, well, now you know why you keep getting stopped out the markets, because the volatility tells you you need to have your stop loss at least 129 pips away from the live price. So if we went over to our spreadsheet, we typed in the live exchange rate price and we put 0.84%, okay, which is the average volatility stop loss. Well, there we go. The stop loss tells us 130 pips is where you need to place your stop loss, and the chart told us 129.4. So basically bang on the money. Now, as we're using a 3-to-1 risk to reward, our take profit needs to be 3 times as much. So 2.52%, okay, is our take profit price. Now, if we go over here and we type and we get the measurement to 2.52%, the stop loss price and the take profit price needs to be 159,066. And again, the 3-to-1 risk reward tells us 159,066, bang on the money. And the stop loss price 153,853. Bingo, 153,853. So we get our 3-to-1 risk reward and we give the market the room it needs to fluctuate, okay? But most importantly, look at the position sizes, okay? 100,000 account here, 100,000 account here, 10% risk here, 10% risk here. But because the stop loss here is 130 pips compared to 74 pips, the position size is different. Over here, it's $76 a pip compared to $136 a pip over here. Because look guys, if we take the trade and we do $76.73 per pip and it goes against us by 130 pips and it hits our stop loss, bingo. Now we're gonna lose our 10%, $9,974, okay? So remember, the position sizing you're putting on is not random, okay? It's based on how much of your account you're gonna risk and where the stop loss needs to be. This is very important to remember, guys. Without volatility numbers, you're gambling. You're gonna always keep blowing your trading accounts. Now, the beautiful thing about this spreadsheet and this strategy, whether you're trading currencies, you wanna take a buy position or a sell position, whether you're trading commodities and you wanna trade gold, for an example, some people don't even know that gold fluctuates by 1% a day on average, okay, over the past year. That is 3,000 pips it moves in a day. Now, some people are trying to do £1 a pip on gold and they're realizing where their accounts are getting blown. Because for you to do that, you would need to be trading, if you want to make sure that you're staying within risk of say 10% of a 10K account, for an example, 31 pence a pip is the most you can do. Otherwise, your accounts get blown. So this spreadsheet gives you the calculations for commodities, for currencies, for stock market indices, okay? And it shows you how much the volatility is. In this tab here, you get everything, all the US dollar pairs, all the euro pairs, all the pound pairs, okay? All the stock market indices volatility, all the commodities and cryptocurrencies like Bitcoin as well. So if you're trying to trade, you know how much to place on the trades, automatically done for you. Now, the reason I've been able to help many traders who've used this system to trade the markets with unbelievable success, and what you'll see is, if you come over, some of these members have made ridiculous amounts of money in very short periods of time, because when you're managing risk, you're trading like a professional and you're pretty much guaranteed to make profits, okay, as long as your strategy is just half decent. That's how this member turned 5 grand into 25,000 trading with this strategy. This is how Benjamin turned 1 grand into 12,000 pounds, okay, following this strategy. And there's so many testimonials of members who followed this 4 simple step process to risk management, automatically calculated for you. You'll never ever blow your trading account again, and you'll finally get to being consistently profitable as you've always hoped for. That's the power of understanding how to use risk management properly. So if you're struggling to trade and you've been blowing your trading account, this is exactly what you need. You need to get your hands on this spreadsheet so you get all the volatility data, okay? You get your hands on an onboarded one-to-one call with me, and you can come trade alongside me for 3 months inside my VIP channels, okay? I have a limited amount of spaces of people I onboard a month, so you gotta move quick, okay, if you want my time, okay? So click the link below, come and get your spreadsheet, transform your trading forever, and you'll never ever blow your trading account again.